So you're looking to raise money for your startup. Welcome back to part 4 in our series on the ultimate guide to startup fundraising. Today, we're talking about the biggest mistakes startups make when fundraising. And you need to really tune into this one because you need the money in your business. You need it now. And you can't afford to wait. You can't afford for your round to take longer. And you can't afford to get terrible terms to cripple your startup. So let's get to it. Fundraising, one of the most important things of any venture scale company, because you're building something out of nothing and you generally don't have the money to do that or the business model to support it. So to do that, you've got to bring in VC funding. You've got to bring it in fast. The problem is it's not easy to do. Something like 99.9% of companies fail to raise money ever from outside investors. You need to be that 0.1%. To do that, how do you take your company, get it ready, get your pitch deck, get your process, get everything in line? Because fundraising is hard. Fundraising, not all investors are created equal. And let's be honest, this is probably the first time you're raising money, so you have no idea what the F you're doing. The stakes have never been higher. But you know what? That's a startup. That's what you signed up for. So let's get started. Mistake number 1 that founders make, fundraising too soon. You've got an idea, you're ready, you're excited, you want to build this thing. Now someone just got to give you some money to do it. Yeah, that's a terrible sign. If you haven't started doing something, it means you're worth nothing. Remember, ideas are worthless. Execution is everything. No matter what it is, it all comes down to the execution. And the valuation is going to come down to the execution and the traction you have. So fundraising too early means A, most investors won't care, won't take you seriously, or B, you're going to get a terrible valuation that's going to set your company up for failure in the process because you don't have traction. You haven't proven anything. And 80 to 90% of businesses fail. VCs know that. So when you're thinking about funding or thinking about taking on a co-founder, start to build some traction ahead of time. Generally, as a good rule of thumb, you should at least have a product. You should have something that you've built, put some effort and time into. Investors want to see some sweat equity. They want to see that you fought a bit for this, and it's not you're waiting for someone to give you money to build it. Because if you're waiting for someone to give you the money to build it, it means the world's waiting for you. And that means they're completely ignoring you and they could care less. So now get to work. Would you rather give up 30% of your company right off the start or 10% once you've got a bit more built? Big difference. Mistake number 2, not fundraising too early, but fundraising too late. Sometimes when you're building something, maybe you'll raise a little bit like a friends and family and fools round and pre-seed, but if you take too long to raise money, you're going to run into trouble of the company's growing, and then you kind of got to put the brakes on. You can't afford to hire people. You can't afford to continue with marketing, continue with pushing forward because you're running out of money. You're burning cash. Your burn rate is way too high, or you just aren't sustainable at this point. And to do that, to go on a venture scale business and build something incredible, you're not going to be sustainable initially. You're figuring things out. You're figuring out profitability. That's how it works. But if you don't have enough money in the bank to do that, you're going to get screwed. Typically, fundraising takes 3 to 6 months. I tell founders to book at least 6 months into the process so that they can start early on enough to not have to settle for shitty investors, shitty terms, or just straight up running out of money and dying. Make sure you have enough of a time frame so you can build out your pitch deck, build out your strategy, find your investors, reach out, go through the process, have enough time to do all of the diligence that investors are going to want to do with you afterwards, and then get the money and be able to fund your team. You don't want to have to lay off half the team because you started too late. Mistake number 3, raising not enough money. That means you raise and you're raising again soon. 18 months is kind of the time frame I like to say. You should raise 18 months of runway, not based off of your current runway, but also based off of your projections and the people you plan on bringing on board and the initiatives you plan on undertaking. 18 months is a good number. It gives you a solid year to go, to focus on product, to grow, to get traction, to hit those next milestones. And then that 6 months, of course, that you need to look into raising money and really getting things in line there. 12 months of growth, 6 months of fundraising, and then you're good to go. Again, 18 months. Make sure you take enough money. Otherwise, you're going to be raising money every 3 to 6 months. And that's like eating half of a breakfast and then being hungry 2 hours later. You just get nothing done. Mistake number 4, raising too much money. If you raise too much money, you're going to be too diluted. Even potentially, if you get great valuation, you could run into trouble here. And that's because nobody likes to see a down round. No one wants to see either your valuation stay flat or go down. And they want to see you grow into the valuations and the numbers that you're given. So if you have milestones that look like you should have a $50 or $100 million valuation, and you maybe are half the way there, That means if you want to raise money later on, you're really going to have to kick ass to reach those numbers. And a lot of times that's not possible. So that could mean further along down the road, you've got to take terrible terms, or you're just not able to raise money because investors don't want to have the mark. They don't want to mark down their portfolio. They want to mark it up so they can raise more, bring in more, have more management fees, more carries. For more on the dynamics of how venture investing works and the economics for VCs, go to mattward.io and look at the ultimate guide to startup fundraising. You can see the pros and cons of different types of investors and how the economics of the venture industry works. So make sure you don't want to over dilute yourself. I like to say generally 10 to maybe max of 25% is good for how much dilution you should have per round. Anything more, you could end up hurting yourself. Optimizing for valuation, that's mistake number 5. So valuation is it's not just a scorecard. It's not just being cool on Crunchbase. It's not just a dilution. It's also supposed to measure your company. And like we said, if you're at a certain point and you've got to take it to the next level to raise your next round, you're going to have to hit those valuations that accommodate that next round and accommodate raising money. And to do that, you've got to be able to hit those milestones. Mistake number 6, not optimizing for smart money investors. Sure, you've probably heard that before, but there's money and then there's money. You can take money from the bank or from Aunt Gertie or from the shark investors. You don't want them. You want people that have jobs, track record, that can open up connections, that can help you with future fundraising, help you with bringing on those key employees you need, open up new markets, maybe have intros to corporates, etc. Smart money, again. And the more term sheets you have, the more time you have, the more you can optimize for that. So then there's taking money not from smart investors, there's also taking money from the wrong investors. And that would be mistake number 7. And that's people with maybe the wrong time horizons. They want to see fast money like a hedge fund, and they don't have the time to wait the 10 to 12 years that venture investments take to mature and have some type of exit. Or maybe going with, I don't know, money from the Saudis, the Chinese government, anyone that could give you a bit of a red flag for potential partners looking forward. I don't know if I want to work with these guys. They don't have the best human rights track record, for instance. Think about all those things when you're thinking about the investors you work with. And then there's the flip side, the people that are on the up and up, but could potentially affect your brand or your image. I mean, if you're building a plant-based meat company, you probably don't want to take money from Tyson, because Tyson's one of the bigger animal agriculture, we'll say, firms or slaughterhouses in the US and worldwide. So just think about what customers will think about the partners that you have on board. Mistake number 8, fundraising for a business that's not venture scalable. Venture economics are very straightforward. 1 out of every 10 companies is going to return the other 9 and then some. It's really based on an exponential power law where pretty much VCs are looking for companies that can 50 to 100x, because that's what they need to be able to make up for all the losses and to have the return numbers so that they really can have a decent carry being the difference between how much money their fund initially raises and how much they're able to return to their LPs. That's the majority of how VCs get paid. So they're always looking for outsized returns. And if you have a company that can't hit those outside returns and you try to go about raising money, one of 2 things is going to happen. Either you're going to struggle along for forever trying to get money in and to never be able to, or you're going to raise money and then have unsustainable expectations, i.e. the SoftBank approach, where too much money is thrown at you and you have to try to grow unsustainably and ultimately your company explodes and dies. The problem, VCs don't really care if your company explodes and dies because they have a portfolio, 20, 50, 100 companies. You have a portfolio of 1. So make sure that you're building the business the right way and that it fits the economic model of what you're trying to do if you decide to take on investors. Fundraising mistake number 9, fundraising on bad terms, not just valuation. We all know valuation. You want to get a great valuation because it's less dilution. But there are other things as well that can really screw the company. Double dip preferred shares, giving up too many board seats, bad liquidation preferences, ratchet terms, etc. There's a lot of things that can screw the company in the long run that only come up in the term sheet. For more on this, we've got a bit of a venture terms and fundraising glossary on my site at mattward.io you can look into. And in general, make sure that you get some people looking over your term sheets before you decide to sign on the dotted line, because you could end up signing up for something you didn't have in mind, even though the numbers and everything seem to look good. Mistake number 10, overpromising or outright lying. It's 2 different things. Overpromising, that's a bit more like WeWork. That's Adam Newen. We're going to save the world and we're going to build the next big, incredible $100 million decacorn, and it's all based on real estate. And then we're going to double our revenues and then triple them and yada, yada, yada. All of that's overpromising, and that's problematic. Investors can smell right through that. They're not going to trust you. And either later on when you need more money from them, they're going to say, F you gave us promises and never hit them, or they're not going to invest in you in the first place. The other side, outright lying. And that's Theranos. That's Elizabeth Holmes, and she's going to prison. And if you're lying about your numbers, lying about what you're doing, lying about your technology, there's a good chance you end up getting screwed. So don't overpromise, don't lie. Of course, you do have to be ambitious, shoot for the stars, and have moonshot-like goals and dreams that you get investors excited about. But always be realistic with the types of milestones that you can hit. Mistake number 11, not sending investors updates. The easiest thing that you can do once you have customers is to convert them into repeat customers. It's always easier to get repeat sales and upsells than it is to find new ones. Same is true with investors. If people have already invested in you, they want to see you succeed. They want to reinvest. They want to follow their pro rata or even reinvest more. They should be your biggest supporters. If you're not letting them know how the company's doing, especially if it's doing poorly, then why in God's name are they going to want to invest with you in the future? They're not going to trust you. If they don't trust you, other investors will see they're not following on and will not want to invest as well, because that's a lot of negative signaling. So send out updates to investors. This could be monthly, this can be quarterly, just a little bit of, hey, here's what's happening, monthly growth, traction, people that we've hired, key clients, etc. And then maybe throw one or two things in. By the way, we could use some help with XYZ. And maybe you'll get a little bit of free help in the process. Great way to keep investors engaged and to make follow-on funding much faster and easier. Mistake number 12, once you've had a pitch with an investor, not following up. You've got the pitch, you've got the meeting, you got everything that you needed. Now you just need them to invest, which means you need to get a second meeting, which means that they have to ask you for a second meeting. Follow up. Maybe they forget, maybe they're busy. Either way, you'll look good by following up. And just maybe it'll help you with converting a couple of those first and second meetings into second and third meetings and into investment. And then the last mistake kind of should be the most obvious, but sometimes it's not. It's not practicing your pitch. It's not having automatic answers to investor questions. It's not being awesome at pitching. You should be practicing this a bajillion times. Practice it dozens of times in the mirror, practice it with your spouse, your friends, etc. Write down all the questions and comments investors could have, come up with great answers to all of this. You can't go in cold and be successful. A quick hack for that is pitch the ugly investors before you go for your Cinderellas. So find the ones that you aren't all that excited about. Those are the ones you should you should spend your time pitching first, so that when you goof things up, when they tell you did something wrong, when you stumble over your words, you make the mistakes with the ugly duckling and not the one you really want. So that later on, when you're talking to Cinderella, you're talking to Sequoia, Benchmark, etc., you nail it. And write down all the questions investors have, because the questions one has will probably be the same things that other investors have. You can address those in your pitch. Then you show exactly that you know what you're talking about. You can answer their questions automatically, and they feel like you're an incredibly competent founder they should back. Those are the 13 big mistakes that startups make when they go to fundraise. There's a lot of things you can do right. There's a lot of things you could do wrong. You need the money. You need it in fast. You need to close that round. This has been part 4 in our guide to the ultimate guide to startup fundraising. If you like this and want more, or want help with growing your startup, with fundraising, with attracting and finding investors, etc., please visit mattward.io. I work with startups and businesses just like yours to help them grow, scale, and change the world faster. And if that's something that you like, again, mattward.io. Feel free to reach out. And if it's a good fit, let's work together to grow your business. And either way, I hope this has been helpful. You avoid some of those mistakes so that you can get on with your fundraising, get on with raising your round, and then most importantly, get back to building your damn business, because that's what matters. You shouldn't be wasting your time on fundraising. Till next time, get to work. Cheers.